Welcome to our weekly forecast. My name is Jay Norris. I'm a trading instructor at Trading University. As always, we need to remind you that trading futures and Forex is a risky endeavor and not suitable for all investors. Here's a thought I want to leave you with before we get to the charts. This is a quote from my good friend Bill Williams. Trying to change your trading without first changing your mindset is like trying to convince yourself that a merry-go-round has a destination. Bill, very, very wise man, and that definitely, that's a quote that resonates with me also. Australian U.S. dollars, the first market we're taking a look at. Right away, the big difference between this correction and this correction was you actually technically had what we call a change of direction. You were able to close below the low of the highest closing candle. Here's my highest closing candle right there. That low is somewhere in there. So you close below it on this candle right there. Here, this big red candle. You change direction right there. You never could do that here at the time. Well, here's my highest closing here. See, I marked the low of that highest closing candle. You could never close below the low of the highest closing candle. That low happened to be support all throughout that period at the beginning of the month. So you never could change direction there. Here you change direction. When you do change direction, we would anticipate some kind of a correction. We do have the majority patterns higher here, so overall we're still looking to buy dips in the Aussie. Maybe a little bit bigger dip though than we would normally be looking for. And here's our ratio. He also shifted that 5-day down, so any sell signals in line with that shorter term 5-day would be counter to these important intermediate and even higher time frame patterns, the secondary. So yeah, we would expect a bit of a correction here, but not a full blown reversal. However, next market we look at is the dollar chief. Not much to look at here. We said all along that this rally was nothing but another bear market rally in a long series of bear market rallies. Nothing to get excited about. You'd really have to start get beyond 618, 625, even 2/3, and then hold above that for us to consider a possible reversal here. So as far as we're concerned, you're just in the midst of another bear market rally. I think, though, the next chart, the dollar index, much more interesting chart rather than trade the Swissy. I prefer to follow the dollar index now. A little bit more interesting, as I said, because here you start to see the makings of a bottom formation. There's an old quote: markets turn around like ocean liners. It takes a long time to do it and cover a lot of ground. Similar, I think that's an apropos quote for this market. It takes a long time to turn around. It takes a lot of ground. Look at that. The October 2013 low has still held. And if anything, you're starting to sew in a pattern of there's a higher low, here's another higher low. So long term, this is not a bearish chart at all when we pan out to the weekly chart. And I'm a broken record here. You guys have heard me say it many times. There's no way to cut this, but there's no way to analyze that, but say, yeah, that's a bullish chart. You're holding that 50% retracement. You held it here. Similarly, now you're holding it here. So overall, yeah, there's some short-term momentum down here, but back to that daily chart, you can see that could dissipate in a heartbeat. And typical of Fridays, which often are counter trend moves, you saw the dollar firm up on Friday, counter to really the momentum, the most recent downside momentum. But things really dry up. The volume, etc., really dries up down. You get towards that 79 even, the 79 even figure. Volume dries up. No one wants to press it down there. So that's why we say potentially. It's much like an ocean liner. It takes a long time and a lot of room for that to turn around, and we'll see if that's going to be the case for the dollar index. Next market's the euro. Similar, the volume and the interest in this market really dries up as you get above 139 here. I think this will show up better on an intraday chart, on a 4-hour chart. Let me put the volume on here and show you the volume pattern. Very, very interesting, fascinating. Volume's a tricky subject to cover because it's a good long-term indicator, but it can mess you up short-term. And I'll show you what we mean by that. Look at the massive volume at the end of 2013 and in the beginning of 2013, where you had a lot of players participating in the rally. later in the year. And then many players obviously participating in the sell-off early in the new year. And we could see that because the volume, look at the volume, was tremendous. You had a lot of money flowing through there, good trader participation rate. But what happened here? Boy, it fell off a cliff. Not a lot of participation on this last leg up. Now, technically, you could say this last leg up was not that strong. You didn't have a lot of professionals participating in low volume on the way up. That may or may not indicate long-term weakness. Well, how do you take advantage of it as a trader on something that may or may not be the case, right? Now, just because there's low volume doesn't mean that you don't want to participate in that rally, right? So that's why it's tricky to teach volume. You don't generally see me covering it in a public venue like this for sure. Patterns are more important than anything to me in the market. But speaking of patterns, you could see this pattern where you had good trader participation rate, high volume, then you had low volume on the rally. Now let's scoot down to, let's just take this area. Oh, let's just look back over the last month or so, and you're going to see a similar pattern here where you had, relatively speaking, it wasn't bad volume. It was lighter than it was the end of last year, the beginning of this year. But you know, the volume was picking up. Volume was picking up on the downside here in the euro. And what happened on this rally here? Very low volume on this last uptick relative to that sell-off. So again, volume fell off very similar to what it did. So you had another volume fall, so not a lot of trader participation here, right? So my point being, you know, yeah, long term, we don't see players participating going long in the euro at this level. This is more than likely a short covering rally here. At the same time, it's tricky to analyze that. It's tricky to make money as a trader doing that, okay? Because, you know, volume is not going to cause you to have wins or losses, right? So really, all that matters to me is you have to be on the right side of the market. But my point here being that longer term, this may start to wear on the market, that you don't have traders participating on the upside. That could very well be a sign of longer term weakness in the market. Next market we're going to take a look at is the gold market. And I don't know what to make of gold. You know, you have to watch it here though. You have a potential for a big double bottom in here. This is definitely an area to watch. 1280 for the double bottom. Shorter term, you definitely even need to watch this particular level. It actually closed below it, which is a little bit of a concern for me. But you know, if it firms up. If it firms up early this week, then you know gold's back on in the upside. So this is a big level here, 1295 to watch. Watch 1295 in the gold. If that doesn't hold, look for the double bottom down at 1276. So you know gold, yeah, I like it. If that support holds, I'll definitely be taking a look at gold, you know, right away on the long side as far as buying short-term dips. But if that 12, what is that? I said if 1295 or so, if it doesn't firm up in a hurry there, I'd look for a double bottom around 1278 or so. So watch gold. Potentially could be a nice longer-term trade. Kind of a tricky market. Kind of you know, we all know it's the oldest currency. What makes it tricky is no one's going to give you money to put gold in the bank, right? No one's going to pay you to protect your gold. If anything, it's the opposite. They charge you storage on the gold. So it's not like any other currency where you put it in a bank and they'll even give you a little interest just to protect your money for you. Not the case in gold. So kind of a funny market there overall. Last market, dollar yen. Not a lot to get excited about here. Boy, there's nothing but sideways action here, and you see that showing up in our ratio. Here's the yen. Yeah, the 5 days up, but these all-important intermediate term patterns are still down. Yet you're sitting right on top of a pretty big support here too. So you know, not a lot to get excited about here. If anything, you're in a sideways range. I don't see it going anywhere quick. I don't see it going anywhere soon. And look at that resistance up there. That's a 618. A friend of mine pointed that out to me. That's the 618 of the whole shooting match here. You take the 2007 high to your most recent low in 2012, and that's the 618 at bottom just below there, and that you can see on a weekly or monthly chart. But for now on the daily chart, dollar yen just kind of stuck in a sideways range. Not a lot going on. Hey, thank you so much. We'll leave you with Bill's thought here. It's a great quote. Trying to change your trading without first changing your mindset is like trying to convince yourself that a merry-go-round has a destination. You have to change the way you think. If you're not making it money in the markets, you really need to take a look at the way you think about markets. Okay, it's all about understanding how markets move, not necessarily understanding why markets move. Thanks a lot, and we'll see you next time.